The most successful traders that I know, they are obsessed with the market.
Well, right here, right now, everybody write it down. We're hitting 7,000.
I'm able to make money in the market each day by selling.
I would say my favorite setup is
Thanks for joining on an early Saturday after Thanksgiving. I have Doc here on the call with us. Everybody knows him in my Discord, and I'm sure there are people here from his Discord as well. Doc is an amazing trader. He does a lot of 0DT, Iron Condor, and a lot of butterflies and other strategies too. So I'm really excited to have him here on the call. We got a couple questions from the audience in our Substacks. And so I'm just gonna go off of those questions first. So let's start off with some easy questions. First question is, what is your background? How did you learn to do this? And Doc, do you want to go first?
Sure, I'll go first. To my background, as the name implies, Doc, I'm a psychologist, I'm a retired psychologist. I learned to do this is a long story. The short version of which is my dad, who came over from World War II, right after World War II from Europe, owned a little clothing store, and he somehow was investing and trading on the telephone. I would be in the store at 10 years old and hear him calling up, "Jules, buy 500 shares of Telephonos to Mexico." And then call, I'm not kidding. And then call back 4 hours later. "How much is it now? Okay, sell it." And this is on the phone with no charts or whatever. I'm saying that to say this. It was never something foreign to me. It wasn't like, oh, the stock market, whatever. Oh, the stock market, Okay, so fast forward, career, school, life, whatever. I was involved in the stock market. I read Value Line. I was always kind of like an investor. The great bull market of the 90s, my son was around, whatever. I said, you know what? I need to take a more active interest in growing an account and, growing a nest egg, whatever. My parents had done some of that for us. So, okay. So here we go. Great bull market in the 90s, 1994, 95. I entered the market and, I think most of you know the 90s, subsequent 2000, what happened. That's when I got into trading. I still had my career, whatever. Found the options world somewhere around that time. And again, I found it in the back pages of Barron's. Oh, look, there are these options tables. Oh, look, there's leap options. How did I trade them? Oh, wow, you can sell them. You don't have to buy them. Oh, cool. I just kind of learned about that the easy way or the hard way. 1998, 2000, we've got some technology. The 90s, I'm still downloading options data on my AOL half hour at the end of the day to get options, data. I'm not even kidding. I'm not even kidding. And then my brother, who I trade with, reads McMillan, Larry McMillan, like the options strategist, kind of like the Bible, especially at that time. And so it's telling me about it, and I start reading it. Then I get hooked on things first, the relatively simple stuff, and the more complex stuff. And then we'll fast forward all the way to 1990 to 2015, 16. I'm retired. Um, I've been messing around the market trading, messing around with options. And then I got into it full time, head on. For those of you that know me, I think you kind of know who I am. When I get into it, I got my teeth into it, and here we are.
Awesome. That's amazing that you're able to do this after you retire. And, it's one of those things I feel like you can do until you're 90. I think it's a really great hobby as well because it keeps your brain fresh and decreases the chance of any dementia. From my background, I think most of you read my story on my why. And so, I didn't have parents that taught me about the market or stocks. My parents were not at all financially educated. So I kind of had to learn everything by myself. It was in my, I would say, early 20 when I started working after college that I began to invest passively, like just in the index, opened my retirement accounts, and had really good 401k from my job. So that was what I was mainly doing for a while. And then until COVID happened, I started working from home, have a lot of time while working from home. And I wanted to find something else that can make more money so I can help retire my parents. That's when I got into like full time trading. I started trading just stocks and then I got into futures. And then I discovered options. Then I started doing future options because I thought, it's really great that there's the flexibility of being able to do things overnight. And personally, I find a lot of opportunities during the Globex sections. So that's why, like, for the most part, I trade future options a lot. If you guys are in my Discord, that's what you'll see me doing. What is the overall goal for doing this? I think this is a big one. For me, I think being able to teach people how to trade. I think there's a lot of knowledge gap and within, what the everyday person has and what's required to trade proficiently and consistently, right? And I've been fortunate enough to meet a lot of people through this whole journey who have shared with me, their life stories. It's really touching to like see like how the little things that I do can impact their everyday lives. And I get a lot of like nice story from people too, just like through Discord, like telling me like how making some extra money can mean a lot to them. So that really puts a smile on my face. What about you, Doc? What's your big goal?
Same question and similar answer. Always enjoy teaching. I've always kind of had a knack for it. I've always liked helping people. I'm not going to go back to the stories of what my dad did with immigrants from this town in Poland that came over to the U.S. and beset them, helped them get set up and started here. That's kind of always been in the cultural DNA for me. I've had a lot of mentors along the way. And I've also always been that guy, whatever community I was in, that I'd say, hey, Doc, what do you think of this? What do you think of this trade idea? What do you think of that? And I always enjoyed being able to give my feedback. And people have been really telling me since 2018, why don't you start your own service? Why don't you, do this? Nah, I don't want to bother. So long story short, I started this, but my main goal is really, now I'm going to up a step and get a little esoteric. I think that part of the way the human species is and cultures have evolved is that the fact that we have babies that stay babies for a long time and then teenagers, whatever, and the elders of the tribe teach them and bring them along. And so it's my role, it's our role, those of us who have some sort of skills and abilities to pass that on. So the next person will have skills and abilities to pass on. I think it's sort of goes with humanity, if I want to get kind of overly global about it.
There's a question in the chat. It says, how did you learn all this? I think Doc kind of talked about it. Do you think you are talented in trading so you can learn all this in such a short time, a few years since COVID with no financial background? Personally, I feel confident about my trading skill. But I think with the right guidance and mentorship, anybody can learn how to trade, right, Doc?
A large amount of trading, and we may or may not get to this, is psychological and emotional, not technical. I mean, yes, just technical proficiency, and some people have it more than others, like everything is kind of evenly distributed is throughout the population. So if you have some kind of knack for pattern recognition, visual pattern recognition, if you have some kind of mathematical, skills, let's face it, there is some kind of math in options, it might be basic percentages or whatever. So if you have those basic skills, you can learn it. This was actually a question somebody else asked. I'll throw in a little bit of the answer here. Not everything works for everybody. Some people look at the markets differently, look at options structures differently, different risk tolerances, but it's learnable. You have to find where your comfort level is, but to find what works for you, you still have to jump in the pool. You can't learn how to swim if you're standing on the edge.
Yeah, no, I agree. And so much of it is just having the right mindset and discipline to, follow your trading plan and not trading just because you're bored or because, you're feeling greedy.
Get into trading plan real quickly, and then we'll get to maybe some of the more specific questions. Now, for years, I never really had a trading plan. I just sort of read whatever I read, watch whatever I watched, and kind of have some ideas, a few stocks I looked at, trade them. Only 5 years ago, people kept talking about trading plans, and I was like resistant to the idea. I'm kind of like a by the seat of my pants guy in a lot of ways. Now I'll figure it out as we go along, and I did well. In Gamma Edge, actually, I was a Discord I was in at the time. Right when they were just starting, they were still beta, whatever it was, right? They started writing a trading plan, and he kind of explained like how he does his. He looks at this, he looks at that, identify transition zone, whatever it was. I don't know if he actually challenged us, or I took it as a challenge to write your own. And so, okay, I suppose I want to show that I'm right, of course. And this goes back to what I was saying before. So I started writing my trading plan. Plus, I was reading books, Best Loser Wins. Everyone tells you need a trading plan. I say, you know what? Maybe I need a trading plan. And so I started writing I started following his outline, and that worked okay for me. Then I realized my brain doesn't follow that same pathway. Um, Looking at things that way was okay, but it didn't work for me. Then I started modifying. I started finding the way I look at the market and the way I look at what training structure I need, and then modified it. And the line of my training plan or what I look at, and you guys see it if you subscribe to my Substack, and a lot of it is not behind the paywall, has evolved over time. It continues to evolve. We could tweak this, add a little bit of that, and that. And so part of it is finding that out about yourself.
Yeah,
Are you good? You,
100%.
I've seen you at trades. You're good. You have the instinct. You have the guts. You do. You do. Some people can have the guts.
I do agree with Doc, though. I think having a trading plan or at least, levels that you want to attack for the day is really important. And that's something that I do the night before. I look at, the GEX. I look at the chart. I chart things and then I put down on my notes like what I should be looking for during the day and what are my pivots, my triggers, and then what contracts I would want to potentially take, right? I do a lot of trading on the fly as well. If somebody give me like a good stock to look at and then I see something that I like, I will jump on it. If the GEX changes during the day and I see like somebody put on a big positions and I might want to follow that, I also do that as well during the day. Having a plan is the first step, and then being able to evolve with the plan and to evolve new information as they come in throughout the day is important as well.
Yeah, I do allow see the pins trading during the day too. I get my main trades in that are in the plan. And then, like you say, kind of like a kitten facing a ball of string. Somebody mentions a name, or I see something flash by us. I say, oh, that looks interesting. And I may or may not take a trade.
Yeah, 100%. The second question is best place to start for a trader who is brand new to NASDAQ or SPX and yours and Doc's methods. I think the first thing you guys should do is subscribe to both our Substacks and, join our Discord. That's the best way to learn our methods, right? I mean, like we share every day about what we do and why we're trading trades. And I think you learn best by observing people and then also having the opportunity to ask questions will definitely help as well. I think if you're totally brand new to trading the index, you should start out paper trading. That's what I always recommend to people that I mentor who has never traded like the index or even like futures or future options. I don't think there's a reason to lose real money while you're learning how to trade. With paper accounts, you can learn all the mechanics of trading and even just like the mechanics of using your brokers, because I know there are people with a lot of issues with their brokers. Those are the things that should be figured out. And like you should be comfortable putting on a trade, know how to exit a trade, how to put on stop loss, things like that, before you actually risk real money. And yeah, takes time to get comfortable with a ticker, I would say. I personally, for me, I think it took me about almost 3 years to feel like, I'm at the level where I can like trade NQ really comfortably and be able to advise people and give out trade alerts. So that's my time horizon. I mean, obviously, your mileage may vary. But like I said, if you have good mentorship along the way and even just a good community, I think that will speed up your process a lot more.
And as far as getting started, let's say with SPX, I'm not sure what your level of or anyone's level of familiarity is. So, I mean, if you're getting started with SPX, has been trading Amazon options or this or that, or trading options, let's say short-term weeklies, is different than if you're walking in off the street, quote unquote, and you heard that, hey, options trading is a good way to make money. How do I trade the SPX? It's a different, it's a different conversation. Actually, I'm gonna say this real briefly. The buddy that traded with me, and he came in similar COVID, whatever. We started trading, did really well during COVID with Bitcoin, all that kind of stuff. Made a couple million, lost a couple million, which is not uncommon story. And then he started trading SPX with me, and was trading credit spreads. He did pretty well, and surprised me what he didn't know. So, for example, he didn't know that a 20 wide spread, one of them is $2,000 of risk. Now, it's only a risk if you sit there like a deer in the headlights and let it go through. The times one is 2,000, times 10 is 20,000. So just knowing the mechanics of what you're trading, what your account size is, what the margin requirements are, some of those things, kind of like you said, some of the basics before you even get into the deeper water.
And like I said, you can learn all of that just through paper trading. Like, no need to lose a bunch of money just to figure out, like, the actual sizing that works for you. Right. So let's move on to some of the technical questions. Now we got out of the introduction phase. This one's super easy. What platform do you use to do future spread and option spread? Is there a certain amount of funds you need in account to trade? Um, I use cash account. Do you recommend margin accounts? I can go first for this one. So I use IBKR. I always tell people that IBKR is supreme when it comes to I think ease of use for the mobile app, at least. Like, the platform on the desktop is garbage, so let's not talk about that. But the mobile app, I think, is really easy to use and it has all the functionalities that I need. The only downside is they don't give out margin calls. They have an auto liquidation engine. So that's something that you need to watch out for. So make sure, you have enough margin to cover your position and appropriate stop loss before you go to bed, because you could wake up and not have a very great day. Do you recommend a cash or margin account? I definitely recommend margin account. I think cash account is not an efficient way of using your capital. Wealth is built on leverage, and I stand by that 100%. So always use leverage whenever you can. You just have to be right when using leverage, of course. Like, don't be stupid about it. So I don't believe in cash account. I don't use that. So I recommend using a margin account, especially if you want to sell options.
I use Thinkorswim. Used to be on TradeStation. That's a different story. That was like the state of the art 20 years ago. I use Thinkorswim. Glad you said that about the IBKR mobile app, because I tried IBKR a few times on the desktop, but I just couldn't get past it. So maybe I'll open up a little IBKR account. So I use Thinkorswim pretty much for everything. Yeah, I love it. Like a lot of these things, there's a learning curve. There's a learning curve for how right click here, whatever. And for futures, and use both. I tend to like Tasty. Tasty works for the futures. I find I get a little better margin treatment there for whatever reason. I'm not really sure why. I find the execution is a little better on Tasty for what I do. I'll do like maybe a spread, maybe a 1-1-2. I don't know if you guys are familiar. I'm sure you're probably familiar with it. 1-1-2. It's kind of a longer term strategy where you buy a debit spread and you sell two puts underneath it, whatever. And if it goes down, you make money. If it doesn't, you make money. If you have a 50% crash, then you're in trouble. So I use it for that because it's kind of like a low maintenance. I don't have to really mess with it too much. I pretty much set it and forget it kind of trade. So that's what I use.
What are your favorite trade setups? Ooh. Do you want to take this first, Doc?
Favorite trade setup is going to depend on what kind of trader you are. So if you're buying options long, that's going to be maybe a different trade setup than for a premium seller.
Yeah, that's true.
So that said, as a premium seller, I like to see something like we just had at the end of October. I like to see volatility get all roiled up and then start to normalize. Gamma is my baseline. So I want to see nice, chunky customer long options near where I'm going to sell, a couple layers of them if I can get them. I like to see some market maker short options where I know where the buck is probably going to go when we bounce. And if I get that set up good enough, then I'll take some long trades into that area. I like to do butterflies around those sort of things. I would say my favorite setup is when I have a nice, clear gamma structure that can pretty much predict what's going to happen. Now, let me just say this about technical analysis versus gamma analysis. Technical analysis, that is great. A lot of people use it, make money with it. I made money with it. I had mentors, whatever, is backward looking. It's looking at what happened in the past and extrapolating, okay, something like that's probably going to happen here. Buyers might show up here. They might not show up here. Gamma is forward looking. It's a prescription. If we get here, then market makers will do this. It's not an if, and, or but, it's a will. And so I like to have gamma structure that's going to support what I'm going to do. So the tighter that is, the more I have, the more I'm going to size up, the more confident I'm going to be. Again, one of my previous mentors used to say, and sometimes I might write it in my little note, and some of you might catch it, some of you might not. Don't torture the data. If the data is not there to support it, I might say, well, this level is whatever, but I don't know. Don't torture the data. It's just not there.
No, I agree with you on that, Doc, is that using GEX is super helpful because it is current data, right? You can see exactly what other large participants are doing in the market, and you're not just trading blindly. Most of you know that I also use technical analysis because I do like that. And I think, especially for a lot of individual tickers, you can get very good information from TA. And that will help with, deciding on what kind of trades you want to take. And I do agree with Doc on like trade setup depends on one, your bias, two, the macro environment, and three, where the VIX is currently at, right? When VIX is low, it's actually better to put on trades that, allows you to buy options, right? Because technically it's cheaper. And, the when VIX goes up, your option prices will go up as well. And then when VIX is high, even though it's scary and volatile, it's actually good to be selling options, right? Because, you know, like the concept behind it makes sense, right? Like during high volatile, dangerous time, insurance policy goes up, right? So option sellers, in a way, we are the insurance for people who are buying them as hedges or like, for whatever reason. And so we get the premium up front and we get a lot more premium when there are things that people are fearful of. Okay, so next questions. Of all the asset you trade and structure you use to trade them, what's the most efficient trades that you historically utilized, traded, and profited from? For me, I made the most of my money from trading NQ futures and future options. That's what I continue to do on a daily basis. And that's how I generate, daily income for myself.
Trade NQ, are you scalping long or more premium selling?
Premium selling. And the reason I like doing that is because, there's a lot of flexibility, right? There's a lot of different things that you can do to repair the trade when it goes against you. And then, we talked about this in the Discord, and I wrote an article on it as well. But basically, like with future option, there is the, you get assigned if the put that you sold is in the money. So it gives you the flexibility to now own the underlying, and then you can trade that however you want, versus like cash settle instruments don't have that ability. And then, of course, like the other thing that you can do is like close it out, or take the loss, or roll it out, or do some different structure to help you offset the loss, like if the trade goes against you. And so, with all the flexibility that it has, and also the daily expirations, I like it a lot as an income generating thing.
Efficient might have different meanings. So, for example, I trade SPX. That's my main thing. Whether it's iron condors or just one side or butterflies, whatever it is. So in terms of capital efficiency, well, I don't know. I might have $50,000 or 80,000, whatever it is, between 50 and $100,000 SPX trades going in a day and make $2,000 or 1,000, 1,500. Well, it got capital efficiency. Well, yes or no. It's a 0.5% or 1% in a day times all those many days. Well, that's pretty capital efficient. On the other hand, 100 grand to make 1,000, what? That's not efficient at all. So it depends on what you mean by capital efficient. So, with that said, another thing I want to say is different days and different environments require a different kind of trades. And by now what my pitch is. I know here I'm going to swing, I'm going to go larger, whatever. This is not my environment. I might sell a few spreads instead of selling 15 or 20 contracts. I might sell 5. I might try to buy some options here or whatever. And so there's no one size fits all, is I guess what I want to say. And, the other thing about futures, I don't trade futures on the long side that much, Delta One, but they're kind of easy. It's real simple math. For ES, $50 a point or $5 a point. If you have MES, you don't have to think about beta, this or that, volatility. You just trade it. It's a simple thing. So it's efficient that way.
Advantage and disadvantages of zero DTE. Zero DTE, I love it because you kind of know immediately if you're right or wrong, right? Versus with, other expiration, you kind of have to wait a while for the trade to develop. But with zero DTE, especially with how fast things are moving, for me, I know within an hour of me putting on a tray whether like I need to do something for the tray, or this is something that I can continue holding until like the end of the day, for example. So I like it for that reason. And as mentioned before, I want to make daily income. And so with the zero DT expiration, it allows me to do that. And like at the end of the day, I know exactly how much I made that day. And that's what I use. Disadvantage of zero DT is obviously it's zero DT, right? It decays really fast. You need to be right, or you're gonna find out real quick that you're wrong and you have to do something about it. For people that buy zero DT options, I think that's where it's much harder for them to win, is because data is decaying super fast. Really, you need price to start moving in the direction that you're betting on, so that you can make money, or else you're just gonna continue to lose money as you hold that contract. And so that's why, as premium seller, we're benefiting from that.
So the advantage of zero DTE, there's a few things, kind of similar. Feedback is kind of instant. You sort of know what you're going to get. The other thing, just to use an analogy, I could better predict what the weather's going to be today. I can predict what's going to be on Friday. Can predict what's going to be December 17th, 21st, when options expire. Have much more visibility on what might happen today than on what might happen in a week, a month, etc. And of course, my vision has to be somewhat more accurate as well. That's the main. And also, quick income, quick feedback. In a way, there's less of a judgment call if I'm in a trade that's, let's just say, I'm in a December monthly now or something like that. Okay, so I'm kind of profitable here. Should I take it off? Should I not take it off? What's going to happen? Whatever. Maybe I'm long or something or short a spread. There's a lot more analysis, a lot more uncertainty, a lot more ambiguity than when I'm in a trade that's going to happen today. Kind of like you said, kind of pretty much know what's going to happen. Also know where if something, if this doesn't happen or if something else happens, well, then it's time to get out. One more thing about getting out real quick. Also, like to do management and repair strategies sooner rather than later. I think you said something like, when you know the train is wrong, kind of early. So there's an old proverb, well, it can't be that old because it uses a train, but it says if you get on the wrong train, if you get on the train at the wrong stop, get off at the next stop. But there are times when I get into a spread, let's say call spread, put spread, doesn't matter. And I just don't like the way it's looking. I don't know. It hasn't crossed any magic line. I might be a little profitable, a little in the red. You know what? I don't like this. I'm getting out. I don't have to wait for that magic 3x stop loss or for that magic line to be crossed before I get out, And so that's another thing with the zero DT. I know when that is way sooner than if I'm trading a December monthly.
Yeah, 100%. And I think with the additions of data expiration, which really only started in like 2022, if I remember correctly,
Yeah, I was like, "Here."
a lot of funds have started using it very actively, for their daily trading as well as for hedging purposes. And with that, we have a lot more information from the positioning side of things to help us with our own trades. And I think that's something that we're not getting the same visibility with other weekly or monthly explorations, right? And like Doc said, with the additional information that you get on a daily basis, you can then make more risk informed decisions and have a higher win rate that way. Next question. Could you go into detail about how to handle the credit spread when price goes against you? What step have you found that worked the best? I think we touched on this a little bit already. But like I said, I trade, the future options. So obviously, like there's a lot of flexibility. You can take assignment, you can roll them, you can close it out for a loss. You can, when you roll them, you can also do like other structure to offset your loss, like, sell a little bit lower than your like the current spread or where you think price is gonna go to help you with the cost, right? And then you can also hedge by shorting the underlying itself. For me, when I put on a put credit spread and it like within like an hour or so, I can see that, maybe like that wasn't the right idea or like the selling is much stronger than I had anticipated and it's like blowing through like the next GEX level, for example. Then I would start shorting the entry itself and make it a cover put. So then if I get assigned the short put at the end of the day, then that just closes my position in profit, right? So I think being able to do that is really awesome, and it definitely helps with repairing the trade faster.
Let me ask you a follow-up question on that. Very people do that. So, okay, so now you're short entry and you're short a put, fine, you've got a covered put, whatever you want to call it. Great. What happens if the entry turns around and bees and rips in your face?
That's a good one. So when you're shorting the NQ, always have to stop, right? Especially when you're in profit already, have to stop in profit so that if the market does do like a recovery, like either at the end of the day or like, sometime like before power hour, you get stopped out, that's fine, right? But you don't want to get into a situation where you're like losing on the short hedge as well, right? That's not ideal.
Okay, so you've kind of done the math beforehand, and as it's going, you already know what's happening. Okay.
Yeah.
Okay, so now repair strategies for zero DT SPX when it's going against you. Obviously, you don't have that luxury, although I suppose you could use E-mini or other instruments, but that's not what I do. What I do, a couple of basic ones that I do is, oh, what I call blockers. So let's say I have 20 wide put spread. That's usually my default is 20 wide for whatever reason, sometimes 15, sometimes, but 20 wide is my default. So I might buy a 5 wide debit spread between me and and price. So if it's going down, I want a 5 wide debit spread right in the way. That may or may not take off later. There may or may not be real. It slows the movement down, gives me time to make a repair. It might turn it into a butterfly. So I'm short whatever strike, let's just say like where we are now, 6,800. Let's pretend I'm short a 6,800 credit spread and things are looking a little funny. I'm short a 21. I might buy a 10 wide debit spread, calculate my total cost in the trade. So I got X amount of credit. I spent Y on the to turn it into a debit spread, into a butterfly. So I know my match loss is already what I spent, and now it gives me room to play with it. And so I'll do repair strategies like that using other options around it. And that can get fancy, and a lot of it is experience putting them on. Like last couple of weeks ago, we had some crazy days, and it did a pretty good job, turning lemons into lemonade. And it was to explain to people in the Discord as I'm doing it, as I'm talking about it, as I'm putting copies of my trades, exactly what I'm doing, because a lot of this just was repetitions over time. You see it. I wish I could give you some magic answer that you don't see it. I'm sure it's the same with you. After all, you just see it unfolding and you just kind of see, I got to buy this, I got to sell this, whatever it is, and it just happens. But it starts with practice, with paper trading, with thinking about it, learning goes through different phases and, from, incompetence where, we don't know what you're doing to unconscious to conscious incompetence where, like I said, you don't know what you're doing, where then you become consciously competent. This is a standard learning model where you know what you're doing, but it takes time to think it through and you got to analyze it, whatever. And then you get to a level where it's kind of unconscious competence. You just kind of know. And, we can call it intuition, but it's not really intuition. I mean, it is intuition by definition, but it's learning. It's the way the human brain learns to function and recognize patterns. And so I wish I could give a more um, concrete answer than that. So the concrete answer is I buy debit spreads typically either inside the trade if it's a wide trade or in front of the trade, depending. I tend to pick levels that I think if we go through, it's going to give me a profit. We might stall this. I'll have time to make a choice there.
Yeah, I actually have a friend who loves to buy debit spread in front of his short strike.
Mhm.
If price goes against him, and then he will finance that debit spread by selling further outdated uh credit spread.
Yeah, I'll do something like that too, or further out of the money. Yeah, you play. I make that called Frankenstein spread. Your Frankenstein monster was pieces put together. I'll stitch together some 12 legs, something or other.
And like he said, all that comes with experience. And you just have to like know what tools are available for you to repair things, right? And especially like as you're learning, that's why I recommend paper trading. Like go through a couple of those red day first and see how you react to them, and like see if you can utilize all the tools that you know to repair the trades, or are you just kind of like stuck, and not do anything. Then that's also information for you to know. If you want to play it extra safe, for example, on NQ puts or put spread, would you recommend selling 50 or 100 points lower than your alerted trade? That's a question I got. Short answer is yes, but more complicated answer is when you sell too far out of the money, the risk reward is not there for me. I don't want to take on so much risk, right? Just to make like $50. Um, I mean, if you have a lot of sizing, that can work, but then you have to, be confident that you're right. For me, I'd rather take on a little more risk by selling it not so far away and not selling a tail, than selling a tail and then finding out that I'm wrong. The thing is, when people sell tails, they have to increase their size to increase the premium that they receive. And in that way, I find that it's really easy to over leverage and then find yourself in a sticky situation where you wipe out all of your gains from like months of work because you over leverage, and the market's having a bad day. So I've seen that happen to a lot of people that I know. And I don't wanna experience that. And that's why like I trade the way that I do. But there's definitely people who do sell tails successfully. And I'm not saying that it can't be done, but I'm saying that if you do that, just watch your leverage.
Like selling tails. Okay, so the other from yours. So very familiar with SPX, how it moves, how the premiums move. Almost every point. There's a friend of mine I know what's sitting there, in different veins, whatever. NQ, I'm just not familiar with it. The numbers don't speak to me. When you tell me NQ is at this number, I don't know what that means. If you tell me SPX is at 67.54. Okay, I got these that frame of reference. I know the moving average is near there. I know what predictions are there. I know when we broke it before, when we didn't. So I say that to say this: when I see the NQ trades, hey, I've been taking your trades. I don't usually trade it that much because it could be a wild animal. But I'll move out of the way. I'll let you lead the way. I'll follow. And, you might sell a naked option. I might spread it pretty wide just to give myself a little something or other. But that said, selling closer is a better risk reward. Your theta is going to be much better if you're right. If that thing turns around or just stays there, those 25 delta options become 10 delta options real fast, and you can take them off better. So there's no one size fits all answer. That said, I like selling tails because usually getting back to the gambler position has got a pretty good. I know where the walls are between me and that. And so I'm not going to sell a tail just to sell a tail. I might not sell a N delta option on, let me look at on SP because the liquidity sucks. And yeah, I don't know what's going to happen but I will against SPX. But if I know what's in between me and this.
If you're gonna sell tail, it's better to do it on the index. There's less chance of you being wrong because you have more information and you have daily expirations, right? Versus selling tails on individual tickers, there's a lot more variables involved, right? Like a CEO could come out and say something that the market doesn't like, and you wake up the next day and it's down 28%. Or like they could have earnings and something bad happens on the earnings. That's also a risk. And then most tickers are have weekly or monthly expiration. And so you kind of have to wait a lot longer to find out. And during that time, you are exposed to other variable that could cause the stock to drop.
Out of the blue, they do a secondary.
Yeah, or they do offer it, right? A lot of unprofitable company do that to get more money.
A lot of the momentum stocks that a lot of us trade, I mess around with them a little bit too. Okay, we're doing good now. Our share price has gone from 20 to 115. We're doing a secondary, folks, and then it goes down 20% in a day.
When does it pay to no longer sell volatility? Or how long should one continue selling volatility in the current environment? Is there a seasonal bias this year which favored the Russell over the S&P, or is it too hard to tell? I was just gonna say the Russell is a piece of crap and I don't trade that. So I have no good answer there. I just don't like trading garbage companies, so I don't trade Russell.
Now, I trade IWM sometime, opportunistically. I'll sell puts on it. I haven't lately. I'll sell puts on IWM. RUT, not as much. Hmm. I like to do flies on the Russell because on IWM because it's got higher IV. If I pick my center strike that I'm selling the body and the right, I just get a little convexity toward me. A lot of decay. It's very forgiving. I can hang around. I was hanging around in IWM fly for almost, I don't know, it was profitable. Then we had this whole mess that we had the last couple of weeks. It was in the toilet. It looked like it was going to be a total loser. We bounced, we turned around. I got out at about 30% profit because because of the fly and because of the IV. Now, that said, let me get to the question. So, about the right IV environment, about 15 to 20 VIX. I'm just going to use VIX as a proxy for IV because the VIX doesn't tell me what IV is tomorrow. It tells me what it tells me. It's the math of what options premium is priced in 30 days from now. Actually, it's not even 30 days from now. It's the Friday before 30 days from now and the Friday after 30 days from now, based on the formula that they use, is what the VIX really is. VIX is a math problem, is all VIX is. Mm. So, but using that as a default. VIX 15 to 20 tends to be a good environment. Mm. And again, counterintuitively, a lower VIX, 16, 17, 15, really is kind of a good area to sell premium in because guess what? We don't move that much. The market's not that stupid. We don't move that much. You notice a couple weeks ago when VIX was 22, whatever. Oh wow, high IV, great time to sell premium. And what happened? Realized volatility was greater than implied volatility. We ended up growing, the market priced in whatever, let's just say a 1% move, a 65-point move, and we moved 100 points. Okay, so um, it's not as simple as looking where IV is. You have to kind of look at IV structure, you look at the different, time frames, what's going to happen. So short answer, 15 to 20, this environment that we're in now is actually pretty good. It's actually pretty good for another reason. Because of all the fear that happened a couple weeks ago, there's lots of chunky, long puts, hedges that institutions and you know, large entities put on that are sitting there to keeping the market up. There's also long calls that were sold above us that, again, counterintuitively help us. Why? Because if you think of how positive gamma works, let's just say they sold a bunch of 5,900 calls for this week. So as we head up, it gets pushed down. But then what happens when it goes down again? It mean reverts back up. So we keep on mean reverting back up toward those higher and higher sold calls on the top, and the puts below start decaying, and that's kind of the natural drift up that the market gets. So I think this is actually a pretty good environment to sell premium in. Now, realized volatility has been just stubbornly outpacing or not trailing implied as much as it typically does, which again is good because all this stuff is mean reverting. We're going to mean revert back to where we get uh, a realized move of 0.35% plus or minus, let's just call it 25, 30 S&P points. The IV is going to be pricing in 50, 60 S&P points. And there's your sweet spot. There's your sweet spot. As far as the Russell goes, this is not a great time to sell Russell premium in general because garbage as Russell is, well, the Russell tends to outperform in December and January. It just does. So, do you want to sell puts on garbage and then suddenly people realize the emperor has no clothes and the garbage goes down? Not really. Especially up here near all-time highs. Do you want to sell calls into a systematic, liquidity-driven instrument that really has no particular reason to go up other than cause? Not really, so yeah.
Best time to sell, is it before open, or is it sell after 4 p.m. close? For me, if I'm trading during regular trading hours, I usually wait for at least 30 minutes to an hour after the market opens to see the directions. And for, large player to position themselves in 0 DT first, and then I'll put on my trades. If I'm trading the Globex sessions, I like to wait until Asia opens before I put on a trade, unless I have a very strong conviction or bias about a direction that we're going to move in. If in that case, then I might do it as soon as Globex opens.
On the rare occasions that I do that, if I'm going to do it, say at 7, 8 o'clock Eastern time, like in the evening before the real action happens, it's only after a move that I have confidence in it's done. Like after a big sell off or whatever, or a big rally or something like that. Otherwise, it's too opaque. But I do know this one guy, and he has a trade that he calls his theta fairy. And he basically sells, basically sells his pretty wide strangles, naked strangles on ES or whatever index, and is looking to scalp $100 out of it. If 50, just looking to scalp it overnight, let's just say he sells it for, I'll just make up a number off the top of my head. He sells it for $50 and buys it back at 45 or something, just to scalp. But, that's not my trade. For SPX, unlike most people, I like to trade the open. I like to get my trades in as soon as possible. But if you've seen me on my YouTube or Twitter thing where I do my little morning daily plan thing, you'll see, and I'll show it. It's not like I'm hiding anything. I'll put in a trade before the market opens, the price that's not priced into the market. And I say, if I could get 50 cents for this spread down here or up here, I'll take it. I might show 20 cents or 15 cents or whatever. I put it in, and suddenly I hear that beautiful ring that the trade was filled, and I'll put in my 50, 65% buyback because I always like to buy them back. And I'll hear that beautiful ring at 2 o'clock or something. Oh, it's gone. Okay, great. And although I trade ion condors, I don't religiously try to be delta neutral or try to have 15 on the bottom and 15 on top. I may have more on the bottom. I may have more on the top, depending on the timing, depending on the setup, depending on the risk. So if we go down in the morning and then it looks like we stopped, we turned around where I expect, I'll start adding. If I'm red, great, I'll add more. I might add a little lower, even a little higher. It depends. Then if it looks like we're topping out, I'll sell the calls. Then, it's a trend day. Enough with the calls. I'm just gonna leave the puts alone. I'm gonna try and get out of the calls with a gentleman's profit. I'll take 15, 20% profit. I may get out green or turn it into a fly or something, or add to the, whatever. I'll trade it from there. So I like to get them in early, stay within the first hour of my first set. I tend to do sets of 5. Have my first set of calls and puts in, and then I'll go from there. That might end up with 20 on one side or another, depending on the day.
I know some people that do for SPX 0DT, they do like the first tranche between, market open, like the first hour, and then the last tranche in the afternoon, between 1 to 3 p.m. Is that something that you also do, Doc?
Yeah, do it that systematic. I know people do. Used to do an afternoon trade, like a 1 o'clock trade. In my old age, I don't do that anymore as much. My brother, who has a little service, whatever, he just doesn't have the time to devote to it, whatever. He has a few people that subscribe to him. He has a 1:30 iron pounder trade that he does, a 3 o'clock iron pounder trade that he does. They do good. I used to do them with him. Lately, I just don't bother. I got too much else going on.
How to analyze the gets and everything to XSP. Once you use XSP for an account as small as $500, I'll let you take that one.
XSP is 1/10 SPX. And so in terms of analyzing the gamma exposure, the GEX, you're not going to be analyzing the XSP gamma exposure. That's not going to move the needle. What we're looking at is S&P 500 gamma exposure, so we'll just keep the numbers simple. If I think 6,800 as SPX is good, then I think 680 XSP is good. I just take the tenth off. I can adjust my spreads accordingly. Do 5 XSPs instead of 1 SPX if for margin or cash purposes. And also getting back to the hedging question, I haven't done this recently, but I have in the past. I've used XSP to hedge a trade moving against me, either long XSP calls or puts or whatever, or buying XSPs around it. If I don't want to go in full bore with SPX, I can use XSP long to kind of make up for a lot of the difference, especially if I'm going to a Friday expiration and it's a Tuesday. I don't have to worry so much about the theta of that trade, and I can kind of leave that on a little later.
100%. I didn't want to take this question because I didn't want to answer it with somebody with a $500 account size. I think with a $500 account size, you should not be selling premium. That is too small of an account size, in my opinion. And if all you can afford to lose is $500, then you should be focusing more on your career and make more money before you venture into the market. The market is unpredictable, but you guys make it look like it's easy. That's experience. How can someone stop losing money by guessing all the time and find an edge that works? It looks to me that everyone keeps jumping around with no idea when even copying trades makes you lose money. I am a working man that is truly too busy to watch the markets or my trades, but I love the game. So I have been trying to make it work with nothing but losses. What edge is there that takes a setup in the morning and let it ride, taking a few hundred out of the markets each day? I think we kind of answered it along the way already, though. I think, everybody is a very different trader, I would say. You kind of have to find out what works for you, right? Like, I love trading future and future options, but there are people that don't love that, right? The people that don't love trading NQ, they think it's too crazy. And I do agree that it's crazy, but that's why I love it. And so one size is not gonna fit all. And that's why I do recommend, like, you have to, there's nothing that can replace screen time, right? And like actually doing the trades. Like, you can try to copy a lot of traders, but at the end of the day, you're just copying them. You're not actually getting that experience. So do the trades yourself, understand why you put on the trade, or if you're copying somebody, understand why they put on that trade. So when you do the trade, you can then see if the logic makes sense or if that's like something that you don't agree with. And if you don't agree with, then why? Um, as for finding an edge that works to make money in the market each day, personally, I'm able to make money in the market each day by selling premium and by, scalping futures. And I think that comes from being able to understand how other participants are positioning and how the market makers are, going to hedge against that or with it. And also understanding how a particular instrument moves, right? When you trade something for a long time, you just develop this, I guess I would call like intuition or how it moves. But it's actually like unconscious competence, right? Like you just know how it moves and like, oh, this is how NQ bottoms out. Like it does this little pattern thing. Or like, this top thing that it's doing is usually it usually signal that a reversal can happen or this is like a topping process, etc. Um, and like I said, like you just develop that as you trade something over a long period of time. And you're not going to be able to just find a shortcut to like not doing that. Right. And so if you claim that you love the game and you want to do it, then develop time, make time. Everybody have the same 24 hours. So make time to study, make time to look at the chart, make time to look at GEX, make time to understand how the trade works and understand where you need to repair the trade and what you're going to do to repair it and how much money you're willing to lose. Um, think about all of that stuff. And if you feel that you don't have time, then do it at night, right? The future market's open at night. It's really good for people with a 9 to 5 job. So that's why, like, I think the saying that you have no time, that's just an excuse. Like, you just want a shortcut. But the reality is there's no shortcut. If you want to be good at something, you have to practice it.
I agree with a lot of what you said. I'm going to just make a few maybe practical suggestions. And 100%, if you're just copying a trade, of this, they put in buy, sell this, do this, could be a foreign language to you, just a bunch of numbers. Well, then, it doesn't make sense to do it. To understand the trade and understand why the person's entering the trade and understand what you think that trade means, what you think the risk of that trade is. Okay, so that's that kind of a first step. Another thing is, okay, zero DTE kind of takes some babysitting, especially selling premium. Okay. A lot of times it's just like watching paint dry, but also sometimes it can be a wild animal. You can't just walk away from the screen, I think, unless you're trading something really tight, unless you feel comfortable. So a few suggestions. One, there's no one has a gun to your head and says that's me zero DTE. Sell 3 DTE, sell Friday. So you're still in the game. You have time to repair it. You have time to add on one side or the other to see what's going on, to take profits on each side, whatever, as it's moving. When you're at a meeting and the market's dropping 20, 150 points into your short puts. You're not having that. It may have dropped 150 points and you have short puts on Friday and it's Tuesday. It's a very different story. It's a very different story. So that's one suggestion. The other suggestion I would suggest butterflies, broken wing butterflies. Do a broken wing butterfly for a credit. Or there's lots of other structures that you can do. And you don't have to be overly fancy there. I recently just like a week or two ago, last weekend, I did an educational piece on butterflies and a few different flavors of butterflies. So there's a lot of things you could do by just making it a 4-leg trade or a 3-leg trade instead of a two-leg trade, then you don't have to babysit so much.
No, I think those are great tactical suggestions. Now we're getting into the macro questions, or the fun one. The Zweig breath brush looks like it's about to trigger for the second time in less than 1 year. Has that ever happened? What does SPX performance look like 1, 2, 3, and 4 weeks out after it triggers twice in less than 1 year?
That was such a good question that I'm going to be writing a piece about it. I love that question. Okay, so we'll start with the simple version of the answer. Yes, it's happened before historically, depending which AI you ask. It happens 2 times, 3 times, whatever it is. Yeah, it happens. Historically, after it happens, 1 week, 2 weeks, 4 weeks, a year later, it's a good trade. When it happens, when it happens twice. That said, the market, why that trade works is in some ways the market's a machine. Certain conditions happen that cause the precondition for his wide breadth thrust. It doesn't happen out of the blue. We're at all-time high and we have his wide breadth thrust. It happened, his wide breadth thrust is an increase in breadth and the number of your advances over decliners, a certain math, certain formula to it. Well, that doesn't happen when we're at an all-time high and when breadth is good. Because after a breath wash out of a certain amount, and then we recover. So there's a number of factors that go into why as wide breath thrust actually works. The things to think about, the precondition, and people have been talking about the Hindenburg omen, which is kind of like the exact opposite of a wide breath thrust. It's like when breath stops and we're going down and all that kind of thing is happening. So what else is happening that sets up as wide breadth thrust? Volatility is high. So now you have that good fuel, potential energy there that's going to decay. You have the equity only put call ratio as well as the index put call ratio. We have all these ratios high. So it's not just the breadth ratio that's out of whack. If you look at contango, at big futures contango, if you look at the put call ratio, all the ratios, the oscillator, all the ratios are going to be out of whack. The market just tends to go back into balance, into alignment. When it's that far out of whack to set this up, it tends to then slingshot up and stay slingshotting up because there's other conditions usually that underlie what led it up to it in the first place. If that sounds intriguing, stay tuned for my post that's going to be coming out. I might be able to get it done this weekend, if not by next weekend, because it was a great question. And so I dove into the Zweig breadth thrust, into the Hindenburg, into put call ratio, into I'm probably gonna leave dispersion out of it. Short version is there's a lot of mechanics, a lot of systematic stuff, and mechanical stuff that goes on in the market that has nothing to do with PE ratio, has nothing to do with what you hear on CNBC, has nothing to do with anything. It's plumbing.
What are your thoughts on CTA positioning coming into December?
It's a plumbing question. It's a macro question. So first, let me define it for people broadly. CTA stands for Commodity Trend Advisor. Those are funds that are trend traders. And although one would think that these hedge funds with their fancy algos do fancy stuff, and in a way they do, what they basically do is they're basically mostly long only funds. They basically follow the trends. They typically are allocated 110, 120%. They're typically leveraged. Like you said, you make money with leverage. So typically leveraged. And so when we break a magic moving averages, medium term, short term, long term CTAs, when we break a magical moving average, oh shit, we broke the 20-day moving average, CTAs have to sell a certain amount of them. We broke the 50-day more. There's also 520 courses. Nobody really knows everybody's algo. Everybody has different algos, so it's not one monolithic thing. So that's CTAs. I'm going to swing back around to other systematics that you might want to think of in that same bucket. So CTA exposure right now, best I could tell from, I get my hands on institutional research, not just what's, from Goldman Sachs Institutional Research, Bank of America, JP Morgan a little bit. I mean, they're surprisingly not that great on it. And the Moore, which I think is the best on all this stuff. There's a little bit of a difference in where the CTAs are broadly positioned, but most people have it that going into this next week or so, almost no matter what happens, CTAs are going to have to sell a little bit based on their allocation models, however that works. You know, but it's like the number that I read is like a measly 1 point something billion over the next week. Now, if you think of that, that's, whatever, it's 500 million a day. How many market on close orders do you see? 1 billion market on close order, and the SPX moves 3 points. So in the grand scheme of things, there's not a lot of CTA selling that has to be done. And if we stay over the 20-day moving average is one of like the main ones, because now been gracious enough to come down to us to 67.50 from 67.80. If we stay above 67.50, eventually they're going to be adding to the allocation. That's a nice tailwind into December. Now, let's broaden it out from CTAs and let's just talk about something really simple, mechanical, corporate buyback. Guess what? The corporate buybacks, you always hear Microsoft, oh, we're going to buy back X billion, and everybody's buying back their stocks and the big liquidity names that make up the indexes, right? They're going to be buying back their stock. And that's, I think I read 6 billion a week or something that's coming in. So we have more buy money coming in just from the corporate buybacks. And the note from, I forgot whose desk it was, and I think it was Goldman Sachs desk that said, we've been seeing record amounts of corporate buybacks. So guess what? Microsoft has been buying the dip. Meta's been buying the dip if you haven't. They've been buying their own dip. And they're supporting their own stock prices. Now let's throw onto that, we have vol control funds, and then they come in two different flavors. One of them adjust their allocation against an allocation adjustment model, kind of like CTAs, based on volatility. So when volatility is high, guess what? They sell some stuff, so they may go from 100% to 80%, whatever it is, the numbers don't matter. As long as realized volatility is up, or VIX is whatever certain level, they don't buy it. They might sell to lower their exposure. Guess what happened when things normalize? They buy. And so in a way, them and the CTAs, they buy high and sell low. As we start going down, they start selling. As we go up, they start buying. And that exacerbates the trends in both directions. Then you have volatility with premium funds that basically a fancy way of saying premium sellers like you and me. You have ones that basically you always see them in the market that's selling iron conduits and spreads and whatever it is. And when realized volatility and implied volatility start to normalize, they start to sell more. Getting back to that counterintuitive, when VIX settles down, they're actually selling more, creating more positive gamma profits for you to sell around.
Last two questions now, before we can wrap this up. Should we expect more downside from here with AI trades? At its core, the way I see it, when everybody is screaming about AI valuation fears, I, for one, don't think that's the top of AI. Usually, when the mass is agreeing on something, then that's a very crowded trade, and that's not the trade that you want to be in. If all you're hearing is people being scared about AI valuation, and that's what the mass psychology is saying, then for me, I think that's an opportunity. And I want to be like the contrarian there and take the opposite side. I think Michael Berry having a Substack is also a signal. I mean, I think if he was so good at shorting and making money in his short, he would not be having a Substack. For me, that tells me that, sure, he could be right on certain companies having lofty valuations or, doing financial engineering or whatnot, but it's not easy to make money on the short side. It's not easy when you're betting against participants that are long only and people who are actually buying these companies because they believe in them, right? And most of the time, shorts lose. I think like for most people, it's better to invest in companies that actually have good products that matters into this AI evolutions that we are currently in right now, than to stay sidelined and be fearful that we're quote unquote in the bubble or in the top.
Short version of the answer is I kind of agree with you. I think the whole AI bubble thing is just another bullshit narrative that when the market's going down, oh, it's an AI bubble. And when the market's going up, AI is going to save the world. The financial press is in the business of of making news stories, and the news stories have to fit what the market's doing. Well, say the opposite, yeah, but that said, taking off my cynic hat for a minute, there's a lot of structural differences between the AI bubble, quote unquote, that we have now versus previous bubbles. One of which is simply the bubble, quote unquote, is being blown up by multi-trillion-dollar companies. It's not the same thing as pets.com, or some of the bubbles from the early 2000s, or the late 90s. It's not the same as the railroad bubbles in the 1840s in England, where where people will leverage 10 times and borrowing money to build railroads. I had no idea how they were going to pay for it. Now, there might be some companies in here that are going to get caught in the wash. Is there going to be a reckoning at some point? Probably. There always is. There always is. I would say we're in the early to mid innings in this. This has got a long way to go. There's AI, there's agentic AI coming up. That's going to be the next word. There's robotics coming up. That's going to be the next word. There's use cases. There's industrial stuff. There's robot. There's all kinds of stuff coming up down the road. Just like in whatever 1990, whatever, when Netscape Navigator launched. Oh my God, there's a way to navigate the web. Who saw this coming, right? So who knows what's coming with AI and who the winners and losers are going to be. But just getting back to bubble comparison. So let's just look at NVIDIA and use Cisco as an analog. When Cisco was the most valuable company in the world, and I remember it because I owned it, it was trading at a 200 multiple, and Cisco was going to do what NVIDIA is doing. They were going to be the backbone to every internet. They were going to basically build the internet using Cisco. They were selling at 200 multiple. NVIDIA is selling at what, a 30, 25, whatever. Very different animal. Very different animal. So yeah, I'm not worried about yeah, I'm not worried about the AI bubble. There's stocks in there, yeah. What is somewhat concerning is some of the private equity debt in some of this stuff. I don't know how that's going to shake out. We'll keep an eye on that one. But that's not going to help my zero DTE trade on Monday.
That's the advantage of zero DTE, right? Is that you don't have to worry about all of these valuations as much because you're just focusing on very short-term trades. What do you think will happen in December and Q1 of 2026? In December, you have really one major catalyst, right? The FOMC meeting. That's on December 10th. And we actually, a lot of people like to bring up the analog between 2018 and where we're at currently. 2018 also had a very contentious December FOMC that saw a hawkish policy shift and quantitative tightening, right? And the market tanked in December, which is seasonally not what people expect. And now there's the same fear going into this December of what will happen if, the Fed doesn't cut rates. Um, and I think we already seen that play out, right? Like back in the first 2.5 week of November, we saw the selling based on people's perceptions that there would be no rate cut in December. And so you can now see that 6,500 or 65, 6550 SPX is like as low as it goes if there's no rate cut. I think there's probably going to be room to go maybe 100 point lower. But yeah, like we kind of seen the worst of it, right? If there's no rate cut. Now, if there is rate cut, then we'll be on our way to making new all-time high, hopefully into the year-end rally. So I think there's a little bit of upside going into the year-end there. Now in Q1 of 2026, I don't want to predict that much, but typically, when you have a really strong year-end, assuming that we do, then people will start taking profit in January or so. And so you should see some selling into January. And then we might make a top around February. Historically and seasonally, the second year of a presidential cycle, typically not a good year. We saw that with 2022. 2026 is going to also be a second year of Trump's presidency. So there could be some volatility, and so that's something to watch out for.
As far as December and January, barring something really unforeseen, I see 7,000 SPX as inevitable. I mean, right here, right now, everybody write it down. We're hitting 7,000. We're hitting 7,000.
That's the biggest gamma right now on the upside, 7,000.
Right.
Yeah.
It's there because that's where the JP Morgan collar is, and that's where we kind of always end up or beyond. Not because JP Morgan planned it, because they're such geniuses, but because that structure is so big that mechanically we just end up there, unless something crazy happens. Even if the Fed doesn't cut rates, and I think they will, but let's just pretend they don't, we could have another, like you say, pullback, maybe 3-4%, whatever it is. But it wouldn't surprise me if we didn't maybe retest those lowish area and end up with 7,000 anyway, with 2 weeks left to go in the month, some rip your head off something, whatever. It just wouldn't surprise me, I'm not going to bet against this bull, really not. And I think there's right tail hedges going in. A lot of larger institutions are kind of under allocated and they're buying wings. If you look at an option chain, there's the 7,000 call that's sold for the end of December, but there's a lot of 7,000 calls that are bought in the weeklies along the way in 6,900s. There's a path up mechanically. Does it have to happen? Of course not. I'm willing to put my money where out. I'm in the trades already.
Yeah, I agree. From a positioning perspective, the path is up.
And again, I agree that January is less certain. It's hard for me to tell the weather that many months from now, but I'll give you a but. Just as December is the largest expiration for the index, for SPX, January is the largest expiry for single stocks. So, NVIDIA, Paul, so et cetera, et cetera. We tend to, historically, like you said, after the January Santa Claus rally and all that, after the Santa Claus rally in December, early January, usually after December OPEX or the first week or two, suddenly we have like a crappy week or so. And then suddenly into the end of January OPEX heading into that. And then beyond, we kind of have that second guess, new all-time high into end of February. And then we're waiting for the March sell-off. That's just the way the flows go. It's kind of been the way it is. So, and beyond that, or also the JP Morgan collar on the smaller funds is around 7,100 for both February and for both January and February, 7,120. I forgot, I have to look. So I'm going to say that we will see 7,100 before this thing stops. Maybe January, maybe February. I think we're going to see 7,100.
So there you go, guys. That wraps up all the macro questions. Write it down, get your longs in. But yeah, I would say stay cautiously optimistic. Trend to selling option versus buying. I think selling option has a higher win rate. It's just easier to be right when you're selling options. When you're buying options, you really need a lot of factors to go right. With selling option, like a lot of time you're relying on data to do the work for you. So
With selling options, you just can't be very wrong. That's all you have to be
yeah,
is not very wrong. With buying options, you have to be very right about a lot of things.
it gives you more room for error. And I think it's good as well if you're not like monitoring the market all the time, right? Because like I said, there's more room for error. So you can have more flexibility with selling options too. Is your SEX strategy repeatable on individual companies though? Is the question for you.
Kind of with an asterisk. The large liquidity names, Amazon, Tesla, Nvidia, etc. Yes. However, even with them, I personally don't have the visibility that I have with SPX options. With SPX options, I not only know where the gap in open interest is, I know what's bought and what's sold. With Nvidia, if I see 10,000 or 50,000, 200 strike options for December monthly, I don't know if they're bought or sold. I don't know what to say about it. So now I do know that that's a key level. I do know that something might happen there, but I don't have the same visibility on a granular, nuanced level that I have with SPX. So it's repeatable with an asterisk. Now, again, that said, before I had this granularity, I did that and it was successful. But you have to be a little more careful. You don't have quite the certainty. Have to rely more on other things like good old-fashioned technical analysis, support resistance, delta, all that other stuff that you would just superimpose that on.
How much time a day do you spend looking at the market?
12 hours a day, I don't know.
Yeah, I think about the same for me. I think 10 to 12 hours.
Kind of have to love it. You kind of have to love it.
The most successful traders that I know, they are obsessed with the market. It will be hard for you to have them talk about a different conversation. Like if you're talking to them, we're talking about the market. That's it.
My partner, my girlfriend, my significant other, whatever you want to call her, she's not a trader at all. She's a holistic yoga healer, whatever it is. If I say to her, "Oh, that's outside of my Bollinger Band," she knows what that means. If I say, "Oh, that's a low delta setup," she knows what that means. I mean, so I'm sure your partner, your husband, whatever it is, it's the same thing. They know options jargon and market jargon, even if they're not market people.
My husband jokes that I love the market more than him. So there you go. For small account, which strategy worked best? Can we replace MNQ with NQ? Yes, represent you can replace MNQ with NQ. Just know that MNQ is more illiquid, so you might have some difficulty like getting in and out. But I think that would be the only downside. What's your typical loss to win ratio in terms of amount? Is a typical win 200, but a typical loss 2,000? That depends on how tight your spread is and how tight your stop loss is, and when you decide to repair your trades. I mean, you guys have access to my trades spreadsheet, so you know what my losses are. Some of the stock credit spread that I do, they're like between, I would say, 200 to 400% loss when I decide to roll them. I would say like that's typically like where you can see the loss compared to the gain. What about you, Doc?
Just using the analogy of 200 to 2,000, try not to be mean. If you sit there like a deer in the headlights, watch it crash through your long strike or your short strike on one side or the other, well, then you're gonna lose 2,000. And if you have 10 of them, you're gonna lose 20,000 minus the credit you received. Hopefully, whether like you said, you have a stop loss, or you have a drop dead point, or even there were times I used to trade 200 or 300 contracts in the three time a week day before we had zero DTE. I don't trade that size anymore. I've taken I've taken $100,000 losses. I did. I learned from it. But one of the things I learned from it in like doing a post-op evaluation is, I know what my average daily and weekly is. I'm willing to lose a week. I'd like rather not. I'm willing to lose a day. I'm not willing to lose 6 months, you know? And so at some point, it's just GTFO. At some point, you just say, you know what? I was dead ass wrong. Goodbye. So
Wow.
whatever that number is for you, whether it's a day, a week, a month, 6 months, whatever that number is for you, or some people say whatever 1% of your trading account. So now what I kind of mess with, I don't have this much in the trade all the time, is about $500,000 accounts. And around five, if I'm down around $5,000 on an SPX trades in a day, I'm going to start considering taking some losses, lightening up, doing a repair, doing something. So I know like that's like about a 1% number, depending on how you want to look at it. Now I don't say, oh, I'm 1%, I gotta do something. But that's sort of, maybe I'll go 7,000, something like that, Yeah, one of those days, once every couple months, last month had two of them. It happens, it's part of the business.
Okay, last two question here, and I think we should wrap it up. Can you can you go more into structure from large institutions such as JPM Collar and their primary effects on retail?
JP Morgan Collar is just one of many systematic or trades that are always there. Other ones are the YLD family of funds that sells, all the covered call funds that sell options. QQQ on video. So there's a whole lot of funds that are out there. A lot of big money selling options, not just me and you. And not just the guys, people listening to this broadcast. They have an effect on retail to the extent that they're going to affect the market. So as a retail trader, they're there, they're going to affect the market whether we like it or not. And so to whatever extent we know about them, understand them, and know how to take advantage of them or get out of their way, either way, that's the way I would look at that.
I agree. If we are close enough, they act as magnets. So it's good to know what those numbers are. But of course, if like it's super far away, like 1,000 points away, then like you don't need to worry about it. Cool. I think that wraps it up, Doc. Thank you so much, Doc, and everyone for being
Sure,
here.
this was a lot of fun. I enjoyed it.
I will see you guys in the Discord.